Welcome to Front Range Facts. This is Anthony Meisner.
This is Jim Marion.
We're here to give you your update for July on our national update.
Yeah, we wanted to just give you a little quick state of the state now that we're halfway through the year. So some of the good news, reality check, and then the outlook for the rest of the year. And it looks like housing is starting to normalize. The unicorn years that we've had post-COVID starting to really settle down, and seasonality is starting to be a factor again. So we're starting to see prices rebound because of the fact that we're in that really juicy summer market for home prices. And the other thing that's really sustaining home prices is the fact that home buyers have very few options when it comes to the inventory out there, and the rates still are kind of being an anchor a little bit on that upward growth with things. So new listings are still declining. When you're sitting on a 3% interest rate, it's kind of tough to swallow a almost 7% interest rate for new purchase right now. And affordability, of course, because you do have such more higher payments, is continuing to be a challenge for the buyers in the market. And then we got the new construction is actually starting to grow. The builders have got more confidence. They're starting to do more developments again, and they're offering more options for buyers and sellers. So we're in the summer market. It's going to be moderate interest, but we're moving forward.
Okay, so check this out. With the average credit score of Americans going up so substantially over the last couple of years, we're basically 20 points up from a decade ago.
No, it's
and
amazing.
Really, through the pandemic years, it looks like it shot up basically 10 points, which is really, on a national level, that's a lot. Right?
Yeah.
So this is pretty cool. This is the average credit score for US. So let's take a look at the average credit score for a home buyer right now. This is amazing to me. And I'm not 100% sure why this is happening, but what did we say earlier? 760 is actually the peak discount you get on the credit score.
Once you're at 760, you could be at 840 and not get any better interest rate, essentially.
Yeah, so you're getting the best interest rates, and the only people, I guess more than half the people buying, the median buyer has a credit score at 765.
Yeah,
which is remarkable. So the health of the credit industry is very, very strong.
So over 50% of the buyers out there have literally the best rate you can get, which is mind-blowing.
Yeah, it's amazing.
I mean, I think we were like, 6 in the 650s or something back in 2008, so
we've come a long ways.
Yeah. And, this is basically tracking the last 9 months roughly of activity from an interest rate perspective. So where are we today compared to where it's been? It still sucks. The interest rates still suck. Let's not try to,
there's no sugarcoating it. It really hasn't changed.
Yeah. So, here we can see, this up and down, we're not at the worst point anymore. But it still is going to be a very expensive, from an interest rate perspective, to, get into one of those mortgages compared to how it was, related to the last few years. But, from a historical perspective, it's really, not that much different than where we have been over the last 30, 40 years.
Okay. So existing home sales steady. What does that really mean? It means that they stopped declining, right? So we are basically averaging 5.3 million a year for the last 2014 through 2019. Those pandemic years where we saw just a huge increase, we had way higher home sales than that, sometimes in the 6-7 million range. And then here we are, 1 million homes less than the last decade.
Yeah. Where, it will not surprise me to be in the 4.3 to 4.5 million in sales for this year. Certainly once you get above 5, that's where you start to see more, normal kind of market activity. And until we get to that point, we have to be basically below 6% interest rates, I think, to make that happen.
Yeah. And I really don't think this is going to go anywhere unless interest rates improve, right? Mm-hmm. So we could be in this situation for months or years, right? We just don't really know at this point.
I mean, the prognosticators are, when you look at all the chief economists, they're saying that we're going to be, dropping about a point or so over the next 12 months. So that's, something good to look forward to. Certainly in the next 2 years, we should expect, below that 6 level to be more of the normal, below the 5, into the 5s perhaps. But right now it's still, drag on future sales.
All right. So existing home sales distribution, this is nationally, and Jim and I were laughing a little bit ago about this because we really don't have a whole lot of home sales in Colorado under 500,000, right?
Yeah,
but the bulk of the home sales nationwide is between 250 and 500,000. So 45% of all homes.
Yeah, like what was kind of the funny thing about it is recently, we've stopped reporting essentially here in our Front Range community. The real estate, industry has basically stopped reporting on sales below 500,000 because it's so rare. And
at least for detached, right? Attached, there's definitely still some stuff there.
Yeah. So for detached homes, the fact of the matter is that stuff to the right of the orange bar right there is basically 30%. Roughly. So 30% of the market nationwide is 100% roughly of the single family market in Colorado Front Range. So quite a bit of difference. So yes, we're still expensive here. And this is from NAR, chief economist. He had just an interesting point to make about available inventory. Obviously, strongly impacts home sales. So existing home sales activity is down sizably because the current supply is roughly half the level it was in 2019. So it's a double-edged sword, right? We're keeping our home prices maintained because nobody has any interest in selling in this market, but we're also greatly repressing the amount of homes that are being bought because there's less available to buy.
Absolutely. All right, so take a look at this one. Months supply of inventory of homes for sale. We're only at 3 months of inventory, which is a seller's market, right?
Mm-hmm.
And what drives prices up in the United States is not enough homes on the market, so we're not in balance, right? So 2011 through 2019, we averaged 5 months. That was more of a balanced market. Things felt okay, and then we got into the pandemic where it fell off a cliff, right?
Yeah.
There was no inventory. Everyone was changing homes. Interest rates were so low, it was super favorable to do that. We have years to dig ourselves out of this hole at the rate we're going.
Yeah, clearly it's just interesting to look at how far off that average we've dropped, but we're starting to eke up a little bit with it, and having more of a balanced market is in everybody's best interest over time. But it is kind of interesting just to see how low we did drop in January of 2022. That's like basically the rock bottom, and hopefully we'll always have a little bit more choice than that. And so there are also 7.1% more homes for sale in June compared to the same time in 2022. It means that there's basically 41,000 more homes available to buy on a typical day in June compared to a year ago. However, the inventory growth rate for homes actively for sale continued to slow for the fourth month in a row. So basically, we have more inventory because homes are taking longer to sell, but nobody's really putting new homes on the market. We're in 4 months now of decline in year-over-year activity for new additions to that market. So it's a very slow, sluggish market in that regard.
Yeah. All right. So new listings improve a little bit, right? I mean, that's a good sign.
Mm-hmm.
The sign is that at least there's some confidence back in the marketplace to where some of these sellers are coming back to market. But just look at how few active listings
Compared
to where we
more
were.
healthy years too.
Yeah, we just are so low in inventory, and that's going to continually keep those housing prices up. So you really don't need to worry about declining housing prices, right?
Mm-hmm.
And if you're a buyer, you definitely want to get out there and purchase even in this higher interest rate environment, because the second those interest rates improve, I think you're going to see a substantial drop off in listing again because you have so much pent up demand.
Yeah, the best time to buy really is now. You can always negotiate the rate later on, but yeah, once the market sees the interest rates drop below 6%, you're going to see a lot of people trying to buy very few homes, and it's going to become just another inventory shortage. And so, here's something to look at that's kind of interesting is the number of homes for sale in June 2023, versus the pre-pandemic years. And so you can see that here in the West we're up 11% from where we were last year. If you remember a couple charts back, we had like rock bottom inventory though last year. So we're essentially it is about as low as we can go. We're still 61% down though right now in the West from where pre-pandemic, let's call it more of a normal healthy market. So our inventory is just rotten right now as far as choices
Right.
go.
We just have a long ways to go. And I think that's the key here is inventory is low. It's not improving nearly fast enough. So we're going to be in a low inventory environment for the foreseeable future.
Mm-hmm.
I think that's the biggest takeaway from these charts.
Yeah. In the final week of June, we noted, and this is from Realtor.com, final week of June, we noted that inventory declined on a year-over-year basis for the first time since last April. And this slowdown was primarily driven by fewer potential home sellers opting to list their homes in the market, which lapped the period of higher inventory growth that started in May of last year. So it's those golden handcuffs again. Everybody's in these really low interest loans. They don't want to sell because they don't want to give up those great interest rates. So you're in this, really, just stalemate essentially of people not wanting to sell, but people wanting to buy and being forced with higher payments when they do. So the active listings are greater than new listings for 13 months in a row. So, we have the current inventory is the active inventory that's on the market. New listings is the new blood that comes in every week when someone puts their home on the market for the first time, right? And so the active listings that there are greater than the new listings that are coming in. And we had the flip side of that happening back, Anthony, if you want to move your head just out of the way a little bit, you can see January 2022, Good job. Good job. Uh, that's why he's paid the big bucks, folks. Oh, now we're all blurry. Shoot. So, basically we've got, this inverse relationship from what we had before, where, there are more active listings, more than the new blood coming in. And in June, the number of homes that were newly listed for sale declined by 25.7% compared to the same time last year. So new listings remained almost 28% below pre-pandemic levels in 2017, 18, and 19. And in fact, the pace of new home listings year to date is 16.4% lower than the first half of 2020 when, guys, that was the pandemic shutdown, right?
That's really saying something.
Yeah.
It's just not real favorable to move. And I think that's the problem, right? People have no incentive to leave their house right now, even if it isn't a good fit.
Yeah.
Yeah.
So there's just very few options for buyers out there. So certainly, like if you got a unique home, it's one of those things that I think you're going to really attract some people to see it. But people are being a lot more discerning with pulling the trigger on things. They're taking longer to do so. And, here's what I think is just kind of stunning when you look at new listings below the previous years. Here we are in June of 2023, 25.7% less.
Blows my mind.
Yeah,
because our local markets are not nearly this extreme. This is seriously extreme.
Yeah. What are we, about 15% maybe in our local market?
I think probably about 20%, okay. If you were looking at the Front Range as a whole. Yeah. Every submarket, of course, is different. But a lot of times, too, back in the past, years like 2019, which really we looked like we were kind of headed into a recession at that point before the pandemic. We had listing behavior starting to slow in our local markets then. You really didn't see it nationally at that point in time. So this is just kind of fascinating to see how drastically lower it is. This is really similar to the latter half of last year. We're probably going to trend right in line with where we were in 2022, starting in August, September.
Yeah. That red line kind of will join the line for 2023. Yeah, correct. So there's like probably like 2 towns in the country that have more listings than they did. I don't know what they are, but this is again from Realtor.com. But looking at the top 200 home markets, so literally it's 4 towns, 4 metro areas is basically 2. Sorry, it is 2.
2 metro
areas. Yeah. So I was right. 2 metro areas out of 200 did have more listings. Congratulations, you anonymous 2.
This one is staggering. Okay, so here we are looking at new home sales versus existing home sales and that divergence in their price. So back in 2014, 2016, 2018.
If you go back to Anthony and I's early podcast in 2018, we actually talked about this.
We did talk about this, yes. But the divulgence between the two, new home sales were quite a bit more expensive than the existing home sales, right? And then over the course of the last few years, that line got closer and closer together. And then the weirdest thing is you would expect, as the shift happens again, that you would expect them to spread apart, right? Like you would think that, you'd start to get some gap between existing and new home sales. Yeah. And right now they are identical.
And so, when we first covered this like 5 years ago in our podcast, it was the typical spread of difference between a resale and a new was 15% in most years. In 2018, it was 30%. So some years it does slide around a bit. But in the last 5-8 years nationwide, it's been about a $60,000 difference between new and resale. And to see this price parity at $416 for a new and $416 for a median, resale home, a lot of, little weird factors are going on. And I think part of it too is builders are incented to kind of keep that, flow going. And so they want to have consistent sales. So they're more willing to give you negotiation power. Whereas the resale, people are sitting on, low interest rates. Maybe they're not as motivated to have to move things because they don't have stockholders to, answer to. Yeah. So prices are stabilizing. So basically this is tracking on Realtor.com what the list price was every month, for the last, few years. What did the list price look like? How does that relate to the current, market? And you can see obviously the slow, steady march of increased prices over time. Right. And we're certainly in kind of what looks like a recovery mode right now.
Green is this year. Green is good. Right?
Green is always good.
Green is good.
Yeah, and more of that green is good, Anthony. Again, another thing. This is Case-Shiller, FHFA, and CoreLogic. Yeah, this is just a continuation really like on. Yeah. So once again, it's validating that the recovery is here, right?
Well, and it also shows that, if you bought in the last year, you're not underwater, right? Yeah. In all reality, unless you made a really bad decision, home prices have gone up much more in the last year than they've gone down,
Hmm.
even during that little saddle we had for about 6 months.
Yeah.
So this is all good news.
And if we're trying to make so this is from the managing director of, of Standard and Poor. If we're trying to make a case that the decline in home prices that began in June 2022 had definitively ended in January 2023, then April's data bolsters his argument. So again, in line with kind of what Anthony and I were saying regarding that, it certainly looks like there is a moderate recovery that's occurring.
Look at this. The South leads the housing starts. That is not our norm, right? I
Well,
mean,
they're always they always do more construction, right? They have a
they
big
definitely do.
sprawl. They love their sprawl.
Okay,
Yeah,
well, this sprawl is about 3x the
yeah,
nearest competitor,
yeah.
which is not normally what we
Well,
see. I think that's
and what's that? The
impressive.
north east, right there, the 100, where
Yeah,
your
go
head's
ahead.
blocking it, right there. Yeah, the northeast. So 9x difference, Anthony. 9x. That's crazy.
It is crazy. We don't normally see it like that.
Yeah,
So
no, it is
that is
gotten.
fascinating to look
Yeah,
at.
and I think it's more of a matter of like those other months shrinking versus
Yep,
any huge explosion in the south.
absolutely.
So this gets back to kind of the senior thesis Anthony and I have been working on for years about where the inventory is over time, and we said like 2-3 years ago we basically if we built 1.5 million new homes a year for 13 years straight we would then have enough inventory for everybody. Well, look at this guys, like
Now we need 1.5 million.
we averaged over 1960 and 1999 1.5. It was kind of good, but then look at that 2008 to 2014, it cut it in half, right? And so that deficit that we built up for the last few years, we finally started to hit it a bit last year, where we started to hit that 1.5 level, which is again taking 13 years at that level, and you'll finally be okay. And we barely scratched the surface of touching that, and we're maybe scratching it again, but we have such a deficit of houses that it's 6-7 million homes probably deficit that the country really needs. And so from a long-term perspective, you need to have more houses, and so it's going to be an inventory shortage for years to come. Couple that with the golden handcuffs, and you've got some serious headwinds here.
Yeah,
So just to sum things up, housing prices continue to show stronger growth than what was previously expected. This performance is a testimony to the strength of demographic related demand. The Gen X and the baby boomers getting historically low interest rates, and millennial buyers coming out there in droves now to be buying, and then also the fact that there's meager supplies basically for people to buy. So from a long term perspective, home buying is good, and we're going to continue to see a very low inventory market coming on. So regardless of the interest rates, it's great to get in today because over the long term, it is going to grow.
absolutely. Well, thank you so much for joining us today on our national market update. I'm Anthony Meisner from Land Title. You can always reach me on my cell phone at 303-968-9868 or ameisner@ltgc.com.
And I'm Jim Marion, realtor here at Coldwell Banker. You can call me at 303-548-0243, or also Jim at ourcoloradohomes.com. And stay tuned. We're going to be also releasing this month state level one that's just going to be a few minutes long, as well as then a local one that'll dive into all the little front range markets. So have a great day, everybody.
See you next time.